everyone, me Kevin here. Are we setting up for a big market crash? The chungus of market crashes. Folks, we've got some stats to look at, and some of them are kind of bothering me. And I would rather be transparent about changes that I'm seeing in the market than pretend or just make random predictions or whatever and then pretend they're always right. I don't like to do that. When changes happen in the market, I tend to be very, very quick at identifying them, and that's my goal. And if I'm not, then I want to be wrong fast. Like they say, it's better to fail fast and know that something you're doing is wrong than to fail to realize it and then totally get screwed, right? So I'm going to pull up a couple things here, but I want to start with this. Take a look, folks. Okay, look at this. Disposable income and consumption falling. Now, just recently, look at this. This disposable income chart is somewhat explainable by stimulus. But we've had the biggest surge in really boost to disposable income, not from the first stimulus check or the second one, but actually really this last set, the $1,400. We've got the child tax credit coming, starting in 6 days. The child tax credit goes out. We've got unemployment. We've got lots of money propping up disposable income right now. But what's interesting is we're seeing a larger decline that is going to be accelerated in September by the removal of the state unemployment boost, or the federal unemployment boost for state unemployment. Now, when some folks hear that, they're like, come on, like $300 a month, is it really that much? It's not just the $300. The $300 is like the icing on the cake. In California, you could get up to $450 of state unemployment benefits. That means you could literally get $750 per month, per week, not working, which, if you think about that, $750 not working per week times 4 works out to $3,000 per month not working, divided by 40 times 4, so divided by 160 if you worked 4 40-hour weeks. That works out to $18.75 an hour not working. Yeah, that is the maximum potential amount of money that you could be getting in California not working. And so when that goes away, because it actually still exists right now, and that goes away throughout the entire country, we expect this real disposable income to potentially fall even lower than where we were previously, because a lot of people still don't have jobs. They don't have the right skills for the new jobs that they need to take in this new economy that we need. And we could potentially see the average real disposable income actually drop below where it was previously, which is scary. But beyond that, take a look at this. Real personal consumption, we've been blowing up after our V-shaped recovery here. We've been blowing up with consumption. People buying more and more. And this makes sense. But take a look at this. We've had our first inflection point here to the downside after the last rounds of stimulus. And now, obviously, we've had these temporary downsides before when we had other stimulus on the horizon, but we really don't have other stimulus on the horizon right now. We have actually less stimulus on the horizon right now, not more. See, these other inflection points, we had more money expected. We had stimulus, $1,200, the $600, and the $1,400. Now we don't. We don't have this vision of maybe, $1,400 again is going to come, or $2,000 a month is going to come. No. We're not only not likely to get a fourth stimulus check, but we're also likely to very soon see a drop off here because those unemployment boosts are going away, right? And this matters. This matters in aggregate because take a look at what's going on when we put some of these factors together. So we have disposable income rotating down, and we're expecting that to go down even more. We're already seeing consumption go down. Oh, but what about real estate? Right. Yes. Okay, so I made a video about this. You may not have seen it yet, so I'm going to just give you a quick little catch up here. I made a much more detailed video on this. Just type in Meet Kevin housing market and you'll see it. But take a look at this, folks. Usually, new home sales start slowing down right about now. You start seeing less listings hitting the market. So far, we have not seen any inflection to the downside in how many new listings we have in the market. Now, usually also, a new listing median price goes down in the summer months. Take a look at this. The blue and gray lines are the baselines you really want to look at because those are before COVID, right? And so you could see median listing prices tend to go down in the summer right before we get a boost around August, September. And to me, this is potentially a sign of school-related, like, hey, let's get this house sold before school starts and people are a little more anxious to drop their prices. But what's actually happening right now in the real estate market is prices are going up. In fact, asking prices are going up more, and in no other year do we have a precedent for that in the last 4 years, which is odd. Asking prices are going up. New listings are stable, so there are solid amount of new listings with higher asking prices. And how's the market responding? Pending home sales are falling at a faster rate than we have actually seen in prior years. That's scary. It's something to keep an eye on. Okay, let's go back to this. So disposable income down, real estate down, consumption down, financial content. Now I know this seems odd, but the consumption of media content around financial stuff is actually falling. Maybe that's because people have less disposable income, so they've got their stock positions and they care less about new buying opportunities because they got less dollahalas. Financial content going down. So an interest possibly in financial content goes down. Potentially we see volumes go down. We see volatility go down, at least in the short term, which compresses, let's say, bought call option pricing because implied volatility goes down and compresses. Volatility crashes or crushes, as we say. Unemployment benefits going down. We know that's going to accelerate the decline in disposable income and consumption, but potentially also financial related investments from retail, right? We've got the concern of this taper coming up in either Q4, Q1, or Q2. So we start tapering. That's less money in the system. Then we have this fear that even though right now retail, travel, restaurants are booming like crazy, remember the warnings that we got, folks. The warnings we got last year, like November, December, were we're going to see a spike at the reopening in activity, but that is expected to be a temporary spike. We're in the spike right now, and it's very easy for us to overassume that what's happening right now is going to continue to happen. When we're in a moment of seeing high inflation, when we're in a moment of seeing a lot of busy retail, then we expect that is going to continue forever. But we were warned last year, and we talked about this last year, that we would see a temporary spike in activity at reopening, which, if you combine the fact that we expect people's disposable income and their consumption to continue to go down, especially as those unemployment benefits go down, then all of a sudden this retail explosion wave that you're seeing could go away. We're also seeing speculation go down. Speculation based on, and not everywhere. I mean, you still got Virgin Galactic and things like M-Ring or Newegg, right? Like really speculative things that have kind of blown up here in the last few days. I shouldn't call Virgin Galactic really speculative, but you know what I mean. And we're seeing a waning of momentum. Like it used to be, we could just look at high short interest stocks and go, oh, this is going to go to the moon. And then a few weeks later, it went to the moon. That's gone. Like nobody cares anymore about the short interest. So we're seeing a relaxation in speculation. In addition to that, why are we seeing bond yields go down? It's because more people are placing money into bonds. Banks are flush with cash, and they're potentially expecting lower levels of inflation, so they're okay with more cash, which, well, guess what Wells Fargo just did? They got rid of people's personal lines of credit. Like, in an era when banks are supposed to be lending more money, and they're supposed to be trying to get rid of cash, Wells Fargo says we're just gonna kill a whole loan program that people rely on? You've gotta be kidding me. That's odd. It's odd that banks want to hold this much cash. It's odd that the repo markets are exploding, the reverse repo markets, which means banks have too much cash. It's odd that bond yields are falling the way they are. If banks were expecting high inflation, they'd be wanting to get rid of this money as soon as freaking possible. It's odd. Then, folks, if we were to expect high inflation, well, then we would jump into commodities and cyclicals. Well, since the middle of May, those numbers haven't been doing that well. Those numbers have been a little boring. They've been falling. We hit peak lumber in the middle of May. Cyclicals have been selling off for the last couple months. Now, sure, they're having a slightly green day today, but look at the chart. Come on, folks. I don't even need to pull it up. At the same time, we're at a record high stock market and we're at record high prices for real estate. Folks, it just seems odd, okay? It's just odd. And so these are things that we have to consider, and then we have to think to ourselves, how do we potentially prepare in markets like this? Because a lot of folks are asking me, Kevin, well, what's the answer? Now, I don't really know what the answer is, but I can tell you what I'm doing. What I'm doing is, first of all, I haven't been buying shares. I have not been buying shares. Now, I'm not going to go into this whole put discussion again because I have been selling some puts on companies that I'd like to own, and I've been closing call options on companies that have shot up. But the point is, in addition to this, also open to, well, first of all, not only being completely out of margin, I'm completely out of margin. I've collateralized about 800,000 in puts, but I've gone from like $6 to $7 million in margin in my portfolio to zero. Somebody asked me, they're like, hey, well, Kevin, you said your portfolio was like $20 million in January. Why is it 19.5 now? Because then I had like $6 to $7 million in margin, and now I don't. That's a big difference. But anyway, you should check out that coupon code link down below for the amazing programs on building your wealth. It expires July 22nd, and then the price goes up again. But anyway, what else? What's another thing that you could do? I mean, I'm not going to go buy bonds. Folks, I am very, very tempted to just sit here and start hoarding cash. And I know that sounds kooky crazy, but hear this out for a moment, because I think it makes sense, and it's just something that I'm considering. So if I sit here and hoard cash, what happens? Well, first of all, the cool thing about hoarding cash is I'm ready. I'm ready for opportunities. If high inflation happens, high inflation, we'll put high, well, then I could always find something to invest in the event that happens, which I expect will happen. If, you know, this inflection point in inflation, where inflation's done this, we'll either go higher inflation or we'll go lower inflation, probably September, October. I personally think that we're going to go down. But either way, I don't mind just hoarding cash for a couple months and then seeing what happens. See what happens with inflation. Chillax a little bit. Maybe spend less money buying stocks and making investments, and focus a little bit more on hoarding. Again, I know that sounds crazy because, you know, we always hear, cash is trash, you know, oh, well, you should, you know, buy this option or this option. Like, you know, I don't mind having more cash than I've ever had before, and just maybe taking a little bit of a chill pill and not trying to go spend money when money comes in. Now, usually I always recommend, hey, when you get money, throw it into the market right away and invest. That's my problem, is I feel like I have this problem of essentially money comes in and I buy stocks right away. But I wouldn't mind actually building up a little bit of a savings account right now, which I know is just like, what? Like, I hate savings. I totally hate savings. But I'm not doing it for the purpose of a savings account. If anything, it's just now let me be on standby for opportunities. That's what I'm looking for. Big opportunities. So that's what I'm excited about right now. I understand that sounds kooky crazy, but that's what I'm thinking about right now. And I wanted to share those thoughts with you. So a little less enthusiastic about making big buys. I will be posting a lot of selling alerts in the Stocks and Psychology of Money group. So as I see things hitting highs where I think, you know what, I'm good here, I've made money, I'm good for now, I'm gonna stand by a little bit, I'm game for that. So anyway, thank you folks so much for watching this video. Hopefully it was helpful, and we'll see you in the next one. Bye.